Sangini?
Yes.
Yes.
Good afternoon, everyone. On behalf of the Committee on Financial Markets and Investors Protection, I welcome you on behalf of the committee to this webinar on strengthening the capital markets through effective taxation. We have with us our chairman, C.A. Durgesh Kabra, and our vice chairman to address us. We also have C.A. Pankaj Shah, who is the Central Council member of ICI, who will be moderating the session with for us today. And as a speaker, we have C.A. Atul Kumar Gupta, sir, who is the past president of ICI. And we also have as a speaker C.A. G. Ramaswamy, sir, who will be joining us shortly. So I would like to call upon C.A. Dayanivas Sharma, sir, to address the participants. Over to you, sir.
Thank you very much, Sangini. Honorable past president of the Institute, Atul Gupta, sir. Welcome to you for this interesting seminar, primarily which is today the crux of lots of investments which are happening at India level. Sir, welcome to you. Pankaj Bhai, welcome to you as well to moderate the entire session. Along with the chairman, I welcome all the audience for this interesting session on strengthening capital markets through effective taxation. Friends, I would like to tell only one thing. Today, when you talk about taxation, those days are gone where it is primarily a paper-filled document that used to be done, which doesn't have any reference. But today, the digital footprint which has actually been created because of the transactions that are getting recorded from a banking system to any purchase which you make or any sale you make, whether it is in form, whether it is a property, whether it is a smallest amount of transaction. When we talk about the UPI payments, we talk about multiple such things. Today, the moment a transaction is hitting a system, that means it is actually hitting or crediting the tax also equally. That means we are left with a digital footprint across the board, and the transaction entered between the buyer and the seller is clearly recorded. The biggest example happens to be the GST framework. The GST framework, there cannot be a better person than Atul Gupta ji to come and talk upon in this particular webinar to say how this tax is getting used for the benefit of raising capital, giving loans, and also creating trust in the entire ecosystem. I had an opportunity to discuss with Atul sir with regards to what kind of transaction mapping which is happening from the GST department and how these people who are investing, the stakeholders who are thinking to invest in form of loan or equity is getting mapped. Even not up to the investment part, but also when we talk about purchase or sale of a transaction, whether the credit rating of that particular customer or vendor is rightly being mapped or not. There are many such things which I hope sir is going to discuss upon, and he's going to give a lot of new outlook on the kind of integration which has happened at the Government of India level, where the biggest positive web which is again created to assess the quality of SSCs which are being reported in India. With this thought process, let me all welcome you all people to take up this discussion forward. And fortunately, we have on the other side, Pankaj Shahji, who is a new addition, who is a new person to the addition of council, who has an exposure not only for the direct tax, but also has got exposure on the IBC aspects as well. That means the kind of depth and knowledge which he's gone through is going to add a lot of value in today's discussion when he's going to have deliberation with the learned and honorable past president of the Institute, Atul Gupta ji. Pankaj Bhai, the ground undoubtedly is going to be there for you. And we all always have been waiting to listen to our past president. Though Mr. Ramaswamy sir is also a past president, he's going to join us. We'll talk about him independently at that point in time. But yes, welcome to you all people. And I hope the newer way of learning tax is going to be shared by Atul Gupta ji, and let's wait for this discussion to come up. Over to you, Sangini, for taking it forward.
Thank you so much for addressing the participants, sir. I would now like to call upon the chairman of the committee, C. Durgesh Kumar Kabra, sir, to address the participants and the speakers and moderators.
Thank you, Sangini. Respected past president of the institute, C. Atul Kumar Gupta ji, the Central Council member, C. Pankaj Shah from Indore, and all other participants to this webinar, which is there on the subject called Strengthening the Capital Markets Through Effective Taxation. And why we have thought of this time that capital market is growing like anything day by day, and our leadership at the country is of the view that by 2047 we will be a developed economy, and the size of economy will grow from 4.2 trillion to approximately 35 trillion. And when these kind of things are there, how the taxation, whether it is direct tax or indirect tax, is going to help the economy grow, and how the taxation data can be analyzed. And the capital market can take benefit of it, or the intermediaries of capital market, maybe, or maybe the stakeholders in the capital market, or the investors in the capital market use all these things for the maximum advantage for them, as well as for the growth of economy. Today, as we all know that in the first session, Atul Gupta, sir, the past president of the institute, will deal with the subject, the GST crystal ball, leveraging transactional data for predictive investment due diligence. That will make a lot of difference. And as rightly said by Daya also, and as far as I know, when I have entered into the council, the focus of Atul Gupta sir was on technology. Technology is only going to make the difference. And in technology, again, data analytics is very, very important. So in GST, what kind of data is to be collaborated and mined and analyzed? Those things, how it will help the investment decisions, will be discussed by Atul Gupta ji. I'm sure that all the participants who are there, when they are investing, they are making the investment decisions, it will be very, very useful to all of them. Beside today's webinar, I would just like to tell that this committee is doing a lot of other activities also. So I would request all the participants, whenever those kind of opportunities are there, please be a part of the various programs and courses of the Committee for Financial Market and Investor Protections. We have launched this year's 2 certificate course, which is very important. 1 certificate course on NBFC, non-banking financial companies, and this is starting first time any publication as well as the course. So I think that will open up the new opportunities for all the people, our professional brothers and sisters who want to make their career into the compliance of the NBFC, non-banking finance company, as the compliance officer or as the auditor or as the internal auditor or so. Then the another course which we have started this year is certificate course on investment banking. That is again going to give a lot of opportunities to young chartered accountant as well as the senior chartered accountants who wants to shift to the career of investment banking after having the vast experience in the practice as well as in the service. So these 2 courses are going to open up various opportunities for the chartered accountants may it be young or the senior one. Now, I'm sure that these will help all of them. I will not take much of your time, and I would say that I'll come again when G. Ramaswamy sir will join and will talk to you for a minute at that point of time also. But I would like to say that yes, I'm 100% sure that Atul Gupta ji is a visionary leader who was the president of the institute and a lot of technological changes has taken at his time. So he is the master of the data analytics, I would say, and will tell you that GST, which is biggest thing in this country, how GST data can be analyzed for the best of the decision. With this, thank you all. And once again, I welcome you all. And I'm sure that the session, which is going to be moderated by Pankaj Shah, the CCM from Indore, will now take the lead to take it forward, the session. Over to Pankaj Shah, sir. Pankaj, for taking this session forward.
Thank you, Durgesh Bhai. Very respected past president of the Institute of Chartered Accountants of India and GST wizard, I would say, Atul Kumar Gupta ji, chairman of the committee, who is a real visionary leader of Committee on Financial Market and Investor Protection, Durgesh Kabra ji, our tech wizard and the man behind AI, AI in ICI, Dayanivas Sharma ji, seniors and friends. Today, we are going to discuss on a very interesting and important topic, how to strengthen capital markets through effective taxation. Taxation has always been a cost to civilization, but how taxation can impact investment, savings, or how it can make a difference, that is going to be discussed today. Primarily, taxation was earlier considered that whenever there is some tax saving instrument, investments will divert, capital markets will get boosted because of the tax policy. So, on one hand, there is a tax policy. On the other hand, the tax repository that is going to bring a great difference nowadays. Tax policy wise, we know that be it income tax, be it GST, there are different policies which change the course. Like earlier, there was a tax exemption on long term capital gain. It has gone. Now, again, there is a rationalization of long term and short term capital gain tax rates. So, there are various differences which are impacting the capital markets. But on the other hand, how the AIS, TIS, and other GST factors, features, how the data, the footprints, audit trails, different kinds of transaction trails under direct and indirect tax, how it is going to impact understanding of a company. I remember my father is also an avid investor. So my father used to see how much tax the company is paying. This shows that that much is the genuine income of that company before investing, because normally there can be notional and inflated incomes which may not be real. So if you want to know about a company, whether it is a good company to invest, you see what is the tax which the company is paying. That was a simple tool. So with this background, today we have an expert whom we are going to listen. We have none other than the GST doyen, past president Atul Kumar Gupta ji, who has a vision of GST and overall capital markets also. So, sir, we would like to know from you about this topic, strengthening of capital markets through effective taxation. In the initial, we'll have your opening remarks, your keynote, and after that, some questions which I feel have been left from discussion. I'll pose those questions with you. So I would request Atul Gupta sir for a keynote address. And before that, if Sangini can give a brief introduction about Atul Gupta sir. और वो कहते हैं ना, सूरज को दिया दिखाने की जरूरत नहीं है. We have our past president Atul Kumar Gupta ji. So sir, word directly to you for your keynote address on the topic at the.
Yeah.
Just wanted to add here, sir, that any of the participants have any questions, they can put them either in the chat box or in the Q&A box, and sir would be happy to take them up.
Right, sir. Over to Atul sir.
Yeah, thank you very much. Madam, give me this screen share rights as well, please. So at the outset, good evening to all my friends who are attending this particular program right now, or maybe whenever they have the time, they will like to hear this particular program. Durgesh Bhai and Dayaji and Pankaj Bhai, Madam, and all my colleagues who are attending this program. A very good evening to all of you once again, and thanks to the committee for giving this opportunity, organizing this program a very apt time when we are witnessing a large scale investments, mergers, takeovers happening in India. And these days, you are that the India is a growing country. India is a growing economy. So we are not only globally but also internally at the intra-country level. There are a lot of investment discussions are happening on a day-to-day basis. So whenever you have a decision that okay, I'm going to invest in a particular company, or I want to take over, even in a case of a NCLT, there are the things which when it is happening. So a very one important question which is being rightly raised by Pankaj Bhai, Dayaji and Durgesh Bhai, that whether the taxes part, that the transaction. So one thing you will feel that okay, what is the tax role in this discussion at all? So Durgesh Bhai will feel, I'm just giving a name only, that Durgesh Bhai will say that okay, I will see the tax liability. So whenever I am taking the decision, say for example, I am taking a decision of 100 crore buyout, and if the tax liability of 20 lakhs is there, that's the only point I will deduct from the purchase consideration. Because earlier days when we were qualifying, we were doing the CA. So we were being told that, okay, you have to deduct this 20 lakhs rupees from the purchase consideration, and that will be the net purchase consideration which you are supposed to agree. And how you are paying that, that is something that, okay, it will be there. But my dear friends, these days, mark my words, that the data which is available. So you are aware that when we say the data is the next oil, the data which we are gathering, the data which the department is gathering, whether it is the income tax data or the GST data or any other law, even if you will agree with me that today the ROC is taking the various Companies Act return in the XBRL format. Why do? Because they want to get the data on a line item basis rather than as a consolidated data. Now, when you are filing a line item data, I am giving you an example that when you are using the e-invoice system in the GST, practically what is happening, Durgesh Bhai, that you are taking the e-invoice, the QR code and the IRN number on each of the invoice from the GSTN department by uploading your invoice, meaning thereby that you are giving the entire details of your transaction. The every sale, B2B sale, you are reporting to the department in a complete manner, that what is the item, what is the price, what is the HSN code, what is the rate of tax, and to whom you are selling. Now, when you are sitting on such a huge data, and if that data within the permission of the government, in the ecosystem of the government is available, that is called the consent data. So if you are having a consent-based data available with you, and if you can do a data mining, not only by creating your own logic, but also putting the AI into that, then what kind of a report you will be able to get, you cannot imagine. So my dear friend, the entire session which I am going to speak is about to understand that what kind of a data which is available through the GSTN system and what kind of analysis you can provide. So it will not be the final liability of the GST which will decide the purchase consideration, Dayaji. It is the transaction analysis. As I mentioned the topic, that it will be a transaction analysis which will be very, very important for all of us to understand, so that you can understand the legitimacy of the transaction itself. So for example, somebody is having a turnover of 100 crore, but you feel that, okay, the turnover of 100 crore is actually not the turnover. There is a transaction between the two guys, the Pankaj Gupta and Pankaj Shah and Atul Gupta. They are selling and buying to each other. And at the end of the day, both of our turnover is 100 crore. Whether that will actually suffice the purpose, whether that will be a legitimate transaction, and whether that should be the purchase, that should be the criteria for the purchase consideration for the investment. The answer is no. So that's why, my dear friends, there are the many things which are available today, which was not available on the earlier days, when you can do a lot of data analysis, and based on that, the investment decision should be there. Now, based on this preamble, that we have a lot of data available, that is the consent-based data. So how it is a consent-based, I just wish to share with you what is this consent-based means. That when you can access the data of a company with whom you are going to give the money, for example, you are a bank, you want to give a money to the borrower, or you want to do an investment decision, you want to purchase the equity of that company, or you are doing a deal of an amalgamation or a merger. In that case, you have all the right available with you that you will say to the another company with whom the subject matter is that, okay, you have to give me a consent to access your data. There are the two type of permission, the consent, Pankaj bhai. One consent is to access the data only. The another is the password based consent when you can modify the data. So I'm saying only the consent to access the data. So if you have the consent to access the data only, then you will be having the entire data available of the subject. I will say the subject means the company with whom you are going to invest, or you want to give the money, or you are going to amalgamate, merger, or something like that. Or practically you will say that with whom you are doing a due diligence. Now the company for whom you are doing the due diligence and you have the entire data available with you, I will request the office colleagues to please open their videos. So now what will happen? There are the 5-6 different points, and then there will be the sub classification available. So practically I will be touching upon around 12-13 points, which are very, very important for all of us to understand that how the transactional analysis can be there. The first one is about the classification, the rate classification. Now there will be a company having a turnover of 100 crores, and they have a understanding that their activity will attract the GST at the rate of 5% or 12%, whereas actually the rate of tax applicable on the same is 18%. Or they believe that they are providing the exempted activity. I recently encountered with a case when some kind of a cosmetic or the plastic surgery, wherein the OPD is also there. Now they were having a feeling that, okay, since there is a OPD available, so it's a healthcare services and it will not be exempt, will not be taxable, and it will be exempted activity. Now, based on their assumption, if you are investing in that particular company, there may be a situation that the entire turnover of the last 5-6 years, as you are aware, that as per the GST provision under section 74, the department can do a due diligence of last 5-6 years and they can create the demand. So if they will create the demand practically with a rate of 18%, at least 1 year turnover will wash away in the tax liability, and the further the interest and penalty will be there. So it's very, very important, Pankajji, that we need to understand that what is exactly the rate classification of this particular business model, in which the subject is doing. Subject means, again and again saying, the company where you are doing a due diligence, either for the investment purpose or for the purpose of the lending or for the amalgamation or the merger. So the company, so let us take that name, company A. So you are doing a due diligence of a company A. Now you need to understand the business model of the company A vis-a-vis the classification provision, that whether whatever the turnover they are reflecting and their tax liability they are showing is appropriate or not. Tomorrow it should not be a case that the classification is wrong and you have a liability of a few hundred crores and you have invested. So that tomorrow, so I will be touching upon the second aspect, the indemnity as well, that how to protect yourself. But first of all, you should have a better due diligence. So the first point which I wish to touch upon is the better due diligence, that how it can be a better due diligence, and the rate classification is there. Then the second point is that you should be aware that how many GST registrations are there. Many times you will find that, okay, you are not aware that the company A is having the 12 registrations, whereas you are doing a due diligence or understanding based on only the 5 or 6 registrations. So you should have, today the facilities are available. You will put a PAN number and immediately you will get all the 12 GST registration available through the API, that, okay, which all registrations are there. So my dear friend, again I am repeating that all these data are available today through the various tools and APIs which are available in the market. So it is not a rocket science today that you want to do a due diligence. It is available in less than 1 minute time that you can do a due diligence for the company A, as I mentioned. Now, my dear friend, after this basic rates GST structure, that what is the classification, the HSN based turnover, because many times he will say that, okay, I am dealing in the iron ore. My company turnover is 100 crore and I am dealing in the iron ore. But if you will be able to take the classification based turnover, the nature based turnover through the HSN code, you may be surprised to know that at times that out of 100 crore, the 90 crore turnover is only the commission income. Only the 10 crore is the actual sale and purchase. On which the 26AS, you will find that, okay, the TDS has been deducted as a commission income. So it's very important that we have to have a HSN based classification also, the turnover also, apart from the rate rationalization, the rate is correct, the classification is correct, and all the registration I have taken care. So practically you will be aware about the turnover, that okay, you have a satisfaction with the turnover part. The second part is the compliance part. Because as I mentioned you, the compliance are very, very important. As per the section 74, I repeat, the liability to do the audit, the investigation by the department is there for the 5 years from the date of the annual return, the filing of the annual return. So practically for 24-25 is the annual return filing date is December 25. So December 25 to 5 years, meaning thereby up to 2030, they can conduct the audit and investigation for the year 24-25. So it's very important that all the compliances which we are talking about should be there for the last 5, 6, 7 years, that you have to check and assure that everything is correct. Now, the first one in that is the comparison of the GSTR 3B versus 1 versus 9. But I am trying to convey you that you are showing the sales as 100 crore, but the tax actually you are paying only on 80 crore, 70 crore or something like that. Then there will be challenge before all of us that, okay, there will be a liability. So you need to predict the future liability using all these tools, that what can be the future liability in this particular case, because you are showing your sales as a 100 crore, but you are actually paying the tax on 80 crore or 90 crore. Then certainly the liability will be there tomorrow. Likewise, the GSTR 9. So there should be a reconciliation between the GSTR 1, 3, 9 and the financial statement. Because in the financial statement, you are showing a turnover of 100 crore, but in the GSTR 1, you are showing the turnover of only 80 crore, saying that the 20 crore is exempted. Now, whether that is actually exempted or not, who knows? So, and then you have to declare the same as well. So it's very important when you are taking an investment decision that whether the balance sheet, the financial statement is matching with the GSTR 1, 3 and 9 or not. Then, my dear friend, coming to the next one is about the 2B versus 3B. There is again, it is a very, very important data that how much credit was available from the department portal vis-a-vis you, how much you have claimed. So this kind of a comparison is also available through the various tools wherein you will be able to analyze. Now, the 2B means that, or 2A or 2B means the credit which is available on the various purchases made by you through the government portal. That ledger count is called a 2A or 2B as per the GST and terminologies and the GST law terminologies. Now, if the credit, say for example, you purchase, your sale is 100 crore, your purchase is 80 crore. On the 80 crore, you must have a credit at the rate of, say, 18% is the rate of tax. Then the credit should be available around 14.4 crores. But in the portal, it is coming only 11 crore. And you are claiming the credit as a 14.4 crore or something like that. Then certainly there will be a demand of 3 crores from the department along with the interest and penalty, that you have claimed the excess credit as compared to available on the portal. Now, whether you will be able to reconcile the same or not, you will be able to justify the same or not, I'm not aware. But ultimately, this will be a case that the department will certainly ask for. There will be a notice from the department. Then, my dear friend, coming to the next one is the allegation of the fake credit. It's a very, very important issue. And today, with the help of the various tools, even within seconds, you can assess that, okay, how much is the allegation available on the suppliers are suspended or cancelled. What is this fake allegation? You are aware that as per the law, I request the office to please mute your brief audio.
Rangini, there's some disturbance. Kindly mute.
So now coming to this, Pankaj Bhai, that for example, as I mentioned you in this example only, the 80 crore is my purchase. Now 14.4 crore is my legitimate credit. It is reflecting in the 2A also, 2B also. I am claiming the same, no problem at all. But after 2 years, even after 2 years, some of my supplier registration got suspended by the department with a retrospective date of 2020. I purchased in 2025. And out of this 14.4 crore, the credit which was related to these 10 suppliers was 2 crore. So what will happen? That again, there will be a liability which will be raised on me for this 2 crore along with the interest and penalty. So when we talk about the indemnity, which the investor has to take, has to see that what is the tax period, time limit, the survival period I am taking. That not only this 2025 or 2026, the present liability which is there, I have to create a survival period in indemnity for the next 7 years. That in the next 7 years, because there are the known liability, there are the unknown liabilities. If the registration of the suppliers will get suspended even in 2028 with a retrospective date of 2027, then again the purchase of 2025 will become questionable. And there will be a liability, not only for this year, but all the years when I purchased from this gentleman. So it's very important that we have to see that whether there is an allegation of the fake credit, whether all the suppliers from whom I am buying, they are also doing a compliances or not, their registrations are active or not, their registration are not suspended by the department or cancelled on the application. So this is something that we have to see before doing a investment decision. Then there is a case of a circular trading. As I mentioned you, that there should not be the instances when I am buying from you and I am selling to you with a margin of 1%. So practically what will happen? Both of us will have a hefty turnover, but actual turnover is not there. So we have to have a not only, because based on the GST data, you can do only the analysis with your buyer and seller. You cannot do a third party, that okay, A, B, C. You cannot do a circular kind of analysis because you have a limited availability of the data only with the Mr. A, the company A, which is the subject matter in the due diligence. But still, there are the instances which we noticed in many occasions when out of the 300 crore turnover, 150 crore turnover is only the circular trading. So how you will be able to do exposure? Whether it is underwriting or whether you are doing an investment. Again, both are very, very, I will say, the dangerous. That when somebody is having that kind of an intention in the mind to inflate the turnover. So it's very important that we have to come up with the actual turnover which is there in the case where I'm going to invest. So this kind of a data is also available today with the help of the various tools. Then, my dear friend, the next point which I wish to, maybe some of you may be noting down, but I will do a help that tomorrow, later on I will create a small presentation and will share to the committee, that the e-invoice. Now you are aware that beyond 5 crore of rupees turnover, for all the B2B transaction, it has to be a mandatory e-invoice applicability. Now somebody is having a turnover of 50 crore, 100 crore, and he is saying that e-invoice I am not issuing. So either the turnover is not genuine, or there will be a liability towards the non-compliance for the e-invoices. So it's very important that you have to see if the turnover is more than 5 crore. If your company where you are going to invest is having a turnover of more than 5 crore, then compulsorily the e-invoice provision are applicable. Then, my dear friend, another very important point is about the notices. So there is a separate tab available in the GST department. First of all, I am talking about the GST only, then I will speak about the other notices, even about the income tax. So now you have to see that when you are doing a due diligence of an organization for the purpose of the investment or the credit exposure, what kind of a notices are there which are pending in the litigation or the adjudication or at the different stages. So as the tab is available for the GST, there is no tab available for the income tax, ROC and other matters. But at the same time, there are the information suppliers through the API. When you will just type a PAN number and you will get all the notices which are being issued to that particular PAN in the last few years, and what is the current status of those notices as well. So these kind of tools will help you to understand not only for the GST, Pankaj bhai, but for all the different law, either whether it is anti-money laundering, it is a corporate, it is a civil matter, it is an income tax matter, or any other matter. So the moment you will do a PAN number, you will put a PAN number, you will get all the cases related to that particular PAN number. So my dear friend, it's very important that we have to understand that what are the notices which are issued for the GST and what are the implications for those notices. What are the chances that the person will win, and what are the chances when even after winning, the department will go to the appeal, meaning thereby the litigation will go on. That is something that you have to keep in your mind before doing the investment in that kind of a scenario. Then, my dear friend, the next point is about the liability towards the ITC, input tax credit. Though there are many points which will be there, I used to tell the 10 mantras for the input tax credit, that the credit is a legitimate credit or not. For example, the credit should be related to the business, you have the valid documents available, and so on. But 2-3 points which are very, very important as far as the ITC is concerned, I wish to deal here. The first one is about the business model. Many times there will be a business model, a bill to ship to. So you have to see, because in the bill to ship to model, the goods will never receive to the person. But the necessary entries, the necessary records are being maintained to substantiate that these transactions are actually the bill to ship to transactions, or these transactions are not only the paper transactions. Number one. Number two, that as you are aware in the proviso given in the section 16, that if the credit will be legitimate, you can retain the credit only and only if you are paying to the supplier within 180 days from the date of invoice. Meaning thereby in the financial statement, you should do a due diligence for the creditors aging. If the creditors are more than 180 days old, meaning thereby there will be a liability towards the reversal of the ITC. So that is something financial balance sheet part. So I'm not touching upon on the GST part. I'm touching on the analysis of the financial statement here. That in case you are doing this analysis of the financial statement, and you should do a creditor aging to see whether the liability towards the suppliers are paid within 180 days or not. And if not, then there will be a liability towards the reversal of the ITC. Similarly, as far as the capital goods are concerned, if certain capital goods are purchased and the credit was taken on those capital goods, but the capital goods are now being sold, then there will be a liability. So one way is that you are doing a going concern purchase, like there will be a going concern amalgamation or a merger is there. And the another point is that, okay, you are selling off certain asset, you are buying certain asset. In that particular case also, there will be a liability that if you are selling your capital goods within 5 years from the date of purchase, then you have to do a reversal of the ITC, which was earlier claimed proportionately. That is something very, very important. We have to note down that, okay, whether the liability towards the same is compliance or not. Now, my dear friend, coming to the expenditure audit. There will be the many expenditure audit which you can do at the level of the transactions. The first one of them is the expenditure audit as far as the reverse charge mechanism is concerned. In the profit and loss account, you will find many figures like the legal expenses, the freight expenses, the sitting fees of the independent directors, the rent-a-cab charges, traveling and conveyance charges. All these charges are, most of them attracts the reverse charge liability. For example, you are paid to the advocate 10 lakh rupees. On that, the 1,80,000 rupees is the liability towards the company A, which is the subject matter here, who has to pay the tax to the government exchequer through under the reverse charge mechanism, whether that was being paid or not. Similarly, the rent-a-cab, similarly the independent director, similarly the GTA related to the freight payment. Now here I wish to touch upon the one very, very important point, which is again creating a lot of demand for the GST, is the expenditure paid in the foreign exchange. That will not be the part of the P&L, but that will be the part of the director's report. So you have to understand, you have to analyze the director report in such a way that you will be able to identify the liability towards the reverse charge mechanism for the any expenditure incurred in the foreign exchange. For example, you are paying the commission overseas. You are paying the some professional fees overseas. In that case, the liability to pay the GST will be of company A, and they have to pay. So whether that is being paid or not is something that you should check. Similarly, the independent director sitting fees will be there in the director's report or the notes to accounts. So you have to see that how much is the independent director sitting fees which is paid, and whether the reverse charge mechanism was complied in those particular reverse charge on those particular expenses or not. Then, my dear friend, again there is a point which is related to the notices, that any ongoing inquiry which is there on the SSC. So you have to see that as well. If that is there, that is something is happening, then you have to see that what will be the outcome of that particular inquiry which is there. Then, my dear friend, coming to the next few points is the key supplier and buyer. Now, with the help of the GST data which is available on a transaction level, Pankaj, I can tell you that within seconds, you can develop a list of the top supplier, top buyers, and even a sales purchase register at your own level. There is no need to ask from the Mr. A, the company A, to give me the sales purchase register. Within 30 seconds, you can prepare a purchase and sales register using the tools in such a way that you are aware about the entire transaction at all, the dependency. Why you are doing this? It is not only that you want to see the suppliers and the buyers of that company, but also you want to see the dependency. Today, we are discussing about the chartered accountants, that we are looking for a group to that how we can sell the goodwill, how we can do a succession planning. So if the Pankaj, you want to give your practice to somebody else, first question will be that, okay, what is your dependency on a particular client? If a particular client is paying you 40% and that client will go away, will not continue with me, then what is the purpose of buying the practice? Similarly, if you are doing a transaction analysis and you are aware about the key suppliers and the key buyers, you have a complete sales and purchase register, you have a dependency chart available with you, that how much is the dependency of this company on the particular supplier or the buyer, then it's very important that you have to see the continuity of the agreement as well. So by having this kind of a GST data available with you, you can not only develop a key suppliers and key buyers, but also you can develop a dependency chart. And even you can develop a 3 years or 5 years sales and purchase on a monthly basis. Now, not only that will reflect you that how much is the monthly sale and purchase, number one. Number two, that how much is this monthly sale and purchase with a particular key supplier and the buyer. And when I talked about the key monthly sale and purchase, that will also reflect the seasonality of the transaction as well. Say, for example, somebody is only doing the business in the last Feb and March, but whereas the business is not a seasonal business, then how it is happening that in the month 10 months your supplies are very small, but suddenly in the month of Feb and March your supply is becoming 10 times or 20 times as compared to a monthly situation in the month of April or May. So everything is happening in the Feb and March. Then you should have a doubt in your mind that why it is happening so, because it is not a seasonal product. So that is something that you can do. And then also you can understand the working capital flow as well, that how this monthly sale and purchase is happening and what will be the requirement of the working capital if I will acquire this organization or I will lend the money to this. For example, he is saying that give me the OD limit or a working capital limit of particular amount. Now his monthly sale in the month of April and May is only 5 lakhs, whereas the total turnover is 20 crores. So whether he is actually required a working capital limit for the month of April or May, the answer is no, because he is not having any sale or purchase in the month of April or May for the years. Not only for this year, but for the years it is happening. The same pattern is there. Then you can also do a kind of a dynamic offering to that gentleman that rather than, because I'm giving you the money, I'm blocking my money. Say, for example, you are there with me for 1 crore of limit. I'm blocking my money 1 crore of rupees for only for you. But whereas based on my analysis, I'm finding that in the month of April and May or April to January, your turnover is hardly 5 lakhs rupees a month. So what is the purpose of giving this OD limit for 1 crore rupees for these 10 months? So the something that can be a kind of an analysis which is available when you have this kind of a data. Then, my dear friend, as I mentioned you, that the various case pendings, which is also very, very important. And then finally, the AML and other related APIs. Now, before I conclude my first part, I give you once again the points which I just mentioned you, that it's very important that first of all, you should do a compliance analysis. The compliance rating. What is this compliance rating of the last 5 years for this gentleman? Whether all the returns are being filed in time, whether they are being filed or not, and if they are not being filed, what is the penalty and interest and fines which are applicable. So the compliance rating is the first part which you should do. The second one is the input-output ratio analysis. Not only the breakup of the B2B, B2C export and exempted turnover, but also for 3 years, 5 years, the input-output ratio will be available to you in seconds. That, okay, what is the purchase and sale for all these years? You will be able to get the analysis. And then the third one is the HSN based classification, that you are aware about the segmental reporting, as we read AS17 in the earlier days. Likewise, you should have a segment reporting available, that with different type of turnover vis-a-vis not only the HSN based classification, but also the rate rationalization. The rate is correct. The rate which the classification is taken, which is correct or not. Then, my dear friend, the comparison of a 3B versus 1 vis-a-vis 9 and financial statement, whether there is an ineligible credit which has been taken or the excess credit has been taken. And one more thing, Pankaj bhai, here I just wish to, I skip here to mention, is the tax payment behavior. You will find many companies are using 98% ITC to pay their liabilities. Whether that is the correct version, there may be the case when you have a new investments. There may be a case when you have a comparatively a first year or second year of your operations and you have a closing stocks available. But apart from the new investment and the closing stock available, there will be hardly any reason of having a 98% credit. Because where is the gross profit margins? So you have to see the GPM. That, okay, where is the GPM, the gross profit margin? If the by 98% is my purchase value out of 100 rupees, practically on 2% GP, where we have a lot of expenses available, whether my business is a sustainable business or not. So you have to understand that tax payment behavior pattern also, which is available in seconds to the investigator. Then, as I mentioned you, the liability towards the fake purchase as alleged by the department, the cases, the classification of the turnover into the circular trading vis-a-vis the genuine trading, the compliance towards the invoicing, various notices which are pending, the creditors aging, the capital goods which are being sold, the reverse charge liability towards the various activities, including the foreign expenses, and then the key suppliers, key buyers, 3 years, monthly sale purchase, 5 years, monthly sale purchase analysis. All these things are very, very important for one to have this kind of understanding, whether so it's not only the GST liability we are talking about. We are trying to investigate the transactions, even the turnover, even the transaction of the business is actually is having a prudence or not. So by having this kind of a prudence analysis, even Pankaj bhai, not only for the purpose of investment, as Durgesh bhai and Dea bhai mentioned, it is even for the audit quality, that many times you will find that, okay, having this kind of a test conducted, even I can improve my audit quality, because I will be aware about the various type of activities which is happening in the organization by having this kind of a data analysis available through the various tools which are there. Then, my dear friend, after doing this, there is another part which I wish to touch upon, is the indemnity. Because whenever you are doing this kind of a exercise, there is another aspect which you have to keep in your mind before doing an investment, that you have to sign an indemnification. Now, when you want to sign an indemnification as far as the GST is concerned, I will give you the 6 points that which should be the part of the indemnification contract. The first one is a pre-completion taxes. That whatever the taxes or liabilities are there, which are available, which are known, that should be the part of your indemnity clause. That okay, if something is happening, something I have to pay, then this is something is a well known. The second one is a hidden liability, the contingent liability. As I mentioned you, that there will be certain liabilities which are even not aware to anybody. For example, some suppliers got suspended later on. Now you have a liability towards them. If you don't have any clause available for these kind of a liability, or any litigation is going on, you are not aware that what will be the quantum of the final liability. So all these points you have to take care into your indemnification, that not only the existing liability, the contingent liability, but also the hidden liability you have to take care in your indemnification. Then the third point which you should be there in the indemnification indemnity contract is the time limit or the survival period. Because many times you will feel that okay, all the liability for the next 3 years will be taken care by the company A. But you are aware that the GST liability may come in 7 years. So how you can have a liability clause for only 3 years? So you have to see that how the liability, the clause will survive. So for not only the time limit, but also you have to ensure the survival period into your indemnity aspect. Then the financial limit. You have to understand the caps and the baskets. Meaning thereby that what will be the time cap, that okay, this much of a liability will be borne by the buyer and the rest of the liability will be taken care by the seller only. But also you have to see that the tax indemnity to exclude from the general basket, because there will be the many other things. So you have to see that the tax indemnity is over and above, because that is something that you are even not aware that today what will be the liability. So that is something that the basket and the caps with the survival period is very, very important. Then how you are going to conduct the claims, meaning thereby the how is claim is to be going to handled post closing the deal. So that is something that you need to clarify in your indemnity contract itself. That tomorrow somebody will say, sorry, now the deal is closed, I will not touch, I will not discuss. But then you have to ensure that how you are maintaining the security, how you are maintaining the asset, how you are maintaining the liability in such a way that the claims will be, you will be able to handle the claims. And finally, the tax grows up. Pankaj bhai, it's very important when you will get this indemnity paid from the seller, there may be a liability on that also for GST. So you have to do a tax gross up also. That if my liability will be there, you have to pay me, the Mr. A has to pay me 22 crore of rupees, then it will be the 2.36 crore. That the tax gross up aspect you have to include in your indemnity contract. Otherwise, what will happen? You will get a 2 crore, but it will be inclusive of 36 lakhs. Somebody will say, no, I decided that, okay, I will pay the tax liability. Now, where is the new GST liability on this compensation as well? So something which is very, very important we need to understand. So my dear friend, this was all from my side. As the Pankaj bhai and other colleagues mentioned that I have to speak up to 4 o'clock. So it's practically 3:58, which I am closing. I am giving 2 more minutes to Pankaj bhai for his deliberation so that we can have more discussion on the Q&A part. But I try to capture just to before concluding I try to capture not only the point where we normally discuss that okay, what is the GST liability in this company, so that I can take care while I am developing a purchase consideration. I am concerned with the more the transaction analysis based on the GST data rather than only the GST liability. Because when I am doing the transactional analysis, then I am getting more insight, not only to decide the purchase consideration, but also to decide whether I have to go ahead with this deal or not, whether I have to go ahead with this exposure of the credit or not, whether there will be the red flags, whether this will become an NPA. This is something that, okay, give a lot of ideas. I will say the food for thought for us that, okay, what will be the right perspective as far as this particular borrower or the organization is concerned. Over to you, Pankaj bhai.
Thank you, sir. It was really very enriching where you highlighted how to do due diligence through HSN based turnover, comparison of GST3 and different forms which are there, future liability prediction, circular trading, how to detect the same and how it will have impact on the investment, e-invoicing, foreign expenditure through director's report, how much ITC is being paid, the behavioral pattern which you have discussed, that was very important. And then GP margins, that is also very important, that how much is being paid as outward liability. All these things sir, were very interesting and important. Some questions are there, though you have addressed some parts. I would just like to throw the question so that if there is something to add, you may supplement the same. First question was regarding GST transactional data. How such transaction data can be leveraged to assess the financial health? I think you have already covered maximum of it. How such GST transactional data can affect the valuation credibility of listed companies in capital market. So anything with regard to listed companies you would like to speak in this?
So, Pankaj bhai, as I mentioned you,
Hmm.
as the whether it is a listed company or any other organization, today 1.5 crore assessees who are registered with the GST department, they have to file a monthly return or the quarterly return as the case may be. And for the monthly return, you have to give a data on a transaction basis. Meaning thereby, you are providing the complete transaction based data. Even when we talk about the sales or the supply, as far as the e-invoice is concerned, you are supposed to upload the e-invoice. You are for taking the IRN number and the QR code. But when we talk about the purchases, so it is not the purchases which are available with you. The entire data is getting auto-populated from the GST department only in the shape of a 2A, 2B. Meaning thereby sale you are uploading, purchases they are telling. So practically on the portal, the time has come when maybe 2 years, 3 years down the line, when your net liability will be auto-populated, and like a OTP, if you will give the OTP, your tax will be deducted and your return will be filed through the OTP only. So when you have this much of a data available with you, whether it is a listed company or unlisted company, subject to the consent given by the organization for whom you are doing a scrubbing. Please, this is very important. And who will give the consent? Who is into the need of the money? So if the borrower is there or the company to whom you are going to buy as an amalgamation, merger or investor, you will say, oh, before due diligence, I need the consent. And once you have a consent available with you, I am telling you, you can do these 30 type of due diligence based on the transactions. So whether any future liability is there, so you can predict the future liability. You can create the red flags. The excess issue of credit notes. There are the cases when I captured that somebody is doing a bill discounting and then issuing a credit note. So practically it's not a bona fide transaction at all. So you can do a lot of due diligences available with you on which you can decide before creating exposure. So even if you are, as a small investor, you will not be able to do. You want to buy the 500 Tata Motor shares. Can you do this? The Tata Motor will give you the consent. But when we talk about the investment, we talk about the investment related to the sizable nature. A size. You are investing, you are merging, you are doing amalgamation, or you are going for a credit exposure as a bank or as an NBFC. Then you have the permission to access the data. You will get the permission to access the data. But as a small investor, practically, if I say whether this kind of a discussion will help, it will not be in a practical manner. But when we have a large merger and acquisitions happening in the country, not only for the listed company, but for the unlisted landscape, then these kind of analysis should be in the knowledge of the investors or the chartered accountant colleagues who are doing the due diligence on behalf of the investor. So it's equally useful for the listed company as well as for the unlisted companies. Whosoever is registered.
Very
with
true,
the
sir.
GST department.
In fact, nowadays we feel that every item of your P&L is verifiable with some third-party records. For
Yes.
sales and all the income, we have GST data, and for all the expenses, we have a TDS data, because there is hardly any expenditure left on which TDS is not there.
Yes.
So sales purchase department doesn't need assessee. They can automatically generate a profit and loss account of the assessee and give it to them, that you can verify, and you
Yes.
can. Absolutely, sir.
Exactly, I'm trying to convey that it's a auto-populated kind of environment where you are providing the data rather than the subject matter is providing the data.
So our role would be to find hidden things, that something which is not apparent, that we can identify through various indicators and through these behavioral patterns in the taxation sphere.
The role of these tools are that as a subject matter expertise, you develop a ratio analysis, you develop a analogy, you develop a correlation and the regression between the data so that you will be able to deploy the AI and other man-made techniques, ratios, so that you will be able to identify the diagrams, the
Right.
bar diagrams, create the red flags for a deep research.
Perfectly fine, sir. There was one more question. What insights can GST analytics provide regarding sectoral performance and investment trends in capital market? How it can guide the fund managers toward industries with high growth momentum? And there is an example given, for instance, rising GST collection in manufacturing or services can signal a sectoral expansion. So how GST analytics regarding sectoral performance and investment trends can guide the fund managers in market?
Again, Pankaj Bhai, as I mentioned you, that if you have the permission, if you have the consent, or based on the continuous engagement for this kind of a due diligence. For example,
Right.
just to share with you, today you are doing a due diligence of a one company, but later on with the agreeing with a bank, you are doing a due diligence for all the 2 lakh customers, the borrowers the bank is having. Now,
Right.
for example, Pankaj, you have conducted the 2 lakh scrubbing, the GST scrubbing for the customers related to a particular bank. Now, if you will be able to, that will be a data lake available to you. Now, if you will develop a tool which can do a sectoral analysis, because you are aware about all the sales, purchase, HSN, something, everything is there. So at least a predictable assessment can be there based on that kind of a data. So it's very important how big is the sample size. If the sample size is a bigger sample size and that is catering all the aspect, then even with the analysis of this GST data, you are aware that how the sector is performing. Because in this 2 lakhs, 1 lakh, 50,000, 70,000, very importantly, Pankaj bhai, you have to understand that not only the different sectors will come, but also the different geographies will come. So it will not be Haryana only, it will not be Delhi only, but you will be getting a feel from the banking sector that, okay, all the 2 lakhs customers are actually having a different demographic profile. So you are aware about the state performance, you are aware about the sector performance available with you. Combining both that, the fund managers can understand what are the particular sector is, how the particular sector is performing. What are the margins, how much liabilities are there, what kind of a performance, what kind of a growth pattern is there, and in which state even they can speak about. So if you will analyze the entire data of the country at times, I mentioned that even the GDP, you can do a GDP analysis because you are aware about the each and every sale and purchase. So that kind of a voluminous data is available. The qualitative data is available today.
Right, sir. Thank you very much.
Just to again repeat that it depends on the how deep you are, how large is your sample size. So if you will do a continuous process for years, the fund managers will have a large pool of data available, either themselves or through some agency, wherein they can develop a I will say, the prediction based on the research over a period of time.
Right, sir. We are having very matured capital markets right now. So the issue is, how can the integration of this GST data with Ministry of Corporate Affairs, MCA, and CBDT platforms? Now we have all the information of MCA master data available with various portals. It is available in public domain. CBDT, AIS, platforms are there. So how integration of GST data with MCA and CBDT? Firstly, how much integration has been done right now? And secondly, how this integration is presently improving transparency and reducing information asymmetry in the capital markets, and how long is the way to go? Presently, we know that there are some integrations, but right now the utilization or full optimum utilization is not being able to be done. So my question is that integration of GST data with MC and CBDT platform, how it is helping transparency, and what is the way forward in this?
Pankaj bhai, I will take you to a very small advertisement in the recent I saw.
Right, sir.
One gentleman was looking to order a pizza.
Hmm.
So he called the pizza company to give me this something that pizza. So they denied that we can't supply this pizza to you. So he mentioned why? Because they mentioned that you have a high cholesterol available.
Oh my God.
We reviewed your medical report and we find that you have a high cholesterol. So this pizza will not be suitable for you. So he asked that why? I'm taking a regular medicine. So they mentioned that you have not given the order for the last 3 months for the medicine. You purchased last time the 100 tablets or 20 tablets, and that will end up, because you have to take one tablet in a day. And so practically from the last 40 days, you have not taken the tablet. So how the cholesterol will be under control? So he mentioned, no, I'm consulting to my doctor every day, every time, regularly. No, we saw that you have not visited your doctor in the last 3 months. So practically, it's the power of the data and the integration of the data. So unless and until you have an ecosystem available, that the entire data will be available, not only available, but it can be integrated with each other. So the integration will be a PPP model, like integration will be a private sector endeavor. But unless and until all the data are available, the legitimately, with the permissions, with the consent based, with all the ecosystem being created, then only it is possible that you will be integrate and the entire data, and you will be able to create the prudence in the economy. I discussed many times that you can, if you will do this prudence, then practically not only the collection buoyancy will be there, the transactions will be more transparent, and the chances of all these different type of activities which are at times are being surfaced, like some kind of a frauds or something is there, they will automatically get minimized. But today, if you will ask me that which of the departments are giving this data available through the ecosystem, they are only in numbers. I salute the GST department that they are giving the data, but otherwise, if you will talk about the MCA or the income tax, they are not giving the data.
Right.
So if whatever the data you are capturing or getting, that is again required a lot of, I will say, the password protection, captcha, this, that, something like that. And I don't feel that, okay, that is a legitimate way of getting the data. So it's very important that all the regulators has to see that it is in the national interest that they are providing this data. Yes, they can provide the data only with the permission or the consent based of the SSC only, and that is something only to get the data, not to edit the data. So you have to give a permission. So there are the two type of permission, as I mentioned you earlier. One is to access the data, and the another is to get the data, edit the data. So get the data is only the things which should be made available, and then the PPP model, as I mentioned you, they will develop the integration of these data, which will be useful for the data analyzer, the fund managers, for the economy, for the growth, for the regulators. Everybody can access that analyzed data for the better prudence, transparency, tax collection, audit quality, everything will be taken care. It is like a blockchain. If you will ask me, what is the blockchain means? The blockchain is a distributed ledger. So Pankaj bhai, I am not aware whether you are through with this blockchain concept or not. If you are exporting a goods from India, there are the 8 parties involved. Today, when you are looking for a bill discounting or LC issuance, there will always be a worry whether whether it will become a good loan or a bad loan. It should not become an NPA. But once you will be deploying the blockchain, meaning thereby the entire chain of 8% will punch their respective transaction. Say, for example, I am giving to a CHA, then he is giving to a shipping company. Then the shipping company is giving to the custom, and then it is going there. Then also in the counterpart country, they are also punching, meaning thereby everybody is punching and creating a legitimacy of the data transaction. And once the legitimacy is approved, then the bank will have the creditor, the lender will have a comfort that my money will not go away. So the blockchain in this particular case will not only reduce the risk of a fraud, NPA, but also it will save a lot of time for the exporter because he will get the early money, early LC discounting, and even at a lower rate of discounting, because the less of the risk, less is the rate of interest.
Right, sir. Great. Then we have already discussed about the role of chartered accountants. I would like to know from you what skills a chartered accountant should sharpen so that he can analyze the GST data and the data analytics to strengthen their advisory role in capital market transactions, and how a SMP, small and medium chartered accountant, can play a role, and how we have investment advisors, chartered accountants are playing a role both ways. But what can be the role of a SMP as well as a large organization?
So
Anything on?
I will speak about the SMP first because I belongs to that category only. So I will say that there are 2-3 things which are required, even not only for this activity, but for any activity. The first one is, as usual, the subject matter expertise. So unless and until you don't have any subject matter expertise, you will be doing only the mathematics equations. LHS is equivalent to RHS. The turnover is matching with the financial statement. Thank you very much. Everything is okay. No. How you will be able to understand the circular trading, the fake invoices allegations, the tax payment behavior, the liability towards the creditor for more than 180 days. So you have to understand that unless and until you have a subject matter expertise, you will not be able to do this kind of analysis. Number one. Number two, now you have to access the data. Pankaj bhai, even if I will give you the access to my data to you, and you are not having any tools available with you, it will take 1 month to analyze my 12 months return. Because first of all, you will download, then you will punch into the Excel, then you will create the formulas, manual formulas, and even then also you will be able, there will be some human errors. There will be the repetition of various exercise. For each case, you have to devote 1 month, and that will not be remunerative as well, because nobody will pay you 5 lakhs rupees for doing a small analysis. So the second thing which is there, that apart from having this subject matter expertise, you have to deploy the tools. Now, it is on the SME versus larger organization, there is a difference. The large organization will develop their own tool, and the SME has to subscribe, take the tools from outside, and use the tool as a tool. Use the tool as a tool to provide the consultancy. On the top of the tool will give the report, but how to interpret the report, how to develop a roadmap, how to develop the analysis, how to give a red flags, how to give a future due diligence, like a pathological lab. Now, I'm giving you an example. The pathological lab is giving us that this cholesterol is less or more, the vitamin D is less or more, B12 is less or more, LFT or KFT giving this indication. Whether you will go to the chemist directly and purchase the medicine? No. The doctors are advising you to come with the report, and I will analyze the report. Many times you will find that there is a dark marker. You will go to the doctor, doctor will say, no need. This is okay, hardly matters. Even if they are showing that the abnormality is there, but it is a routine abnormality. It will automatically rectified in the system. So there is no need to take the medicine. Whereas if you will go to the Google and you will mention that I have this much of abnormality, the Google will show you, give you the 10 different type of disease you are suffering with. So normally doctors are saying that you are a Google patient because you are checking from the Google everything. That will not work. So meaning thereby I'm trying to say that the professional colleagues should have a number one, the subject matter expertise. Number two, ability to use the tool to develop their own interpretation over and above. So tool, please take the tool as a like a pathological labs.
Right.
They are giving you the report. Now you analyze the report. And you should not devote the time on processing the data. The processing of the data will be done by the tool. You are getting a ready-made information available to interpret. So that will save a lot of time of a repetitive nature. So you will be able to devote more time on the analytical part rather than creating the information. You should not be a creator of the information. You should be a user of the information. Like doctors will not check the B12. The doctor will have a machine, will check the B12 of yours. Then I will say, doctor will say, you please bring the report. I will concentrate on my skills.
Right. Perfect. Right, sir. That was really insightful that we have the skills, but we need some pathology type reports type, some tools which should have, which will process the data, and the processed data will be analyzed. So there will be data which will turn into information after our inputs thereon. So we need tools to verify this. Any tools which you would like to suggest?
There are
Though
many.
we have.
I should not be. So there are many, and I just wish to share with you, Pankaj bhai, you are not you must have attended one
Yes.
session by the Chad Harris. He is from CPA Canada. In 2020, when I was the president, we organized a webinar with him. Even he is not having his own office or the residence. He is running his entire life in the RV, a van, where he is running his office. He is enjoying with the family. He is spending his time on the beaches, in the forest, and traveling here and there. And he is having a team of 150 guys. 150 guys. His team. And he is using only these type of tools to entirely manage his office, from a client engagement to delivery, from billing to everything. Only the tools. He has integrated the various tools in such a way that he's enjoying the life as well as he's doing a professional expertise. So anyone who wish to see that particular webinar, that is available on the ICI virtual platform, the name called Chad Harris.
Okay. Great,
So
sir.
I'm trying to just interlink what importance of the tools which are there, whether a tool A or tool B.
Okay.
The chartered accountant, the professional colleagues should deploy more and more tools into their practice. They have to invest. Earlier days, I'm taking more time. One of my senior used to tell me that whenever I was getting a new client, I used to buy a new book. Because only buying a new book and reading that book, I will get more clients. So I used to invest in the purchase of the books. But these days, whenever you are getting a new client, you should deploy a new tool into your ecosystem so that your effectiveness will increase.
Great, sir. Another area which is developing nowadays is ESG, BRSR. So, do you see potential of using data, GST data specifically, in credit rating models or ESG, environmental, social, and governance scoring
for listed entities. We have scoring, ESG scoring and other scoring, environment consciousness. So is GST data relevant and how it can be used for rating of these entities, and especially ESG rating?
So I will say for the ESG, partially yes. But the other aspect you mentioned, the credit rating, it is fully aligned. So when you are saying credit rating agency, I believe that is actually for any credit rating agency, when they are doing an analysis of a company, the GST data is actually the blood. So whatever you will do, you are doing a postmortem kind of a situation. When you are doing a credit rating, that okay, whatever happened, happened. But the GST data not only provide you the historical analysis, but also predict the future as well. So I believe the credit rating agency, it is the blessing when you have this kind of a data. Yes, more integration with the other data, ROC data, income tax data, PFESI data will make things more prudent. But as far as the ESG is concerned, only the expenditure related to ESG and the governance part, the G, ESG, environment, social and governance. I believe that the GST data can support some of the areas related to the governance as well.
Great, sir. Artificial intelligence is the buzzword, and we are doing maximum data analytics through AI also. How can predictive model based on GST data impact investment forecasting? Though you have discussed many things, but something on inventory buildups or demand surge or sectoral slowdowns, how can we identify these things from AI models? If you would like to supplement something on this.
Pankaj bhai, if you will punch the data, whatever the data you are getting, you will accumulate, you will create an AI model around that. It can tell you the behavior analysis.
Right,
Many
sir.
things which are otherwise not available. For example, the use of the excess credit vis-a-vis the relation of a circular trading. Vis-a-vis 5 years down the line, the heavy notices are being issued. The registration got suspended. Now, humanly, it is not possible that you will be able to interrelate for years. For example, you conducted a study of 1 lakh organization over a period of 5 years. Whether you will be able to analyze that, okay, how many of them become NPA? How many of them, their registration got suspended? When the excess credit was taken for more than 95%. So, Pankaj bhai, when you will develop a model wherein you will punch the data, you will provide the data to model in such a way. What is AI? AI is a logic, but logic being taken care by the system, which is humanly not possible. You will not be able to remember 1 lakh reports over a period of 5 years, but the system can. So if you will develop a model wherein you will interrelate some of the aspects, that okay, this happened, then that happened. So it's a logic. You will be able to create, and then you will give a data regularly to the AI whenever you are doing this analysis. Over a period of time, the AI will give you the predictive analysis. The moment the AI will say the credit is 96%, he will say there are the chances of 84% becoming NPA in the next 36 months, based on the analysis of the 1 lakh old reports. So that is the beauty of the AI, which will support the organizations.
Okay. Right, sir. That was really insightful. Right now, SEBI had given a task to our institute also, sir, to identify early signals or triggers for before any corporate fraud. So, how GST data can be used by SEBI to detect market manipulation? Is it possible, first of all, to detect market manipulation or insider trading or these kind of practices by use of some GST data?
I can say that the prudence of the activities can be established. So you are saying that my turnover is increasing, or this is happening, that is happening, but actually it is not. So the transaction, the financial statements, the depth of the transaction can be very well analyzed with the availability of the GST data. But if you will say that there are some kind of a malpractices are happening, the transactions beyond the outside the books, how the GST data will be able to capture. So you will get a prudentiality that the transactions are bona fide transactions. Okay. So built on that only you can assess whether there is a potential or not. For example, you can see the PE ratios. Somebody is having a PE ratio of 25, somebody is having a same sector PE ratio of 5. So rest of the things I can't speak. But you are aware, okay, what is the depth of this business, whether that kind of a PE ratio deserves or not. So again, as I mentioned you, that if you will deploy an AI model and over a period of time, you are punching the data into the AI model, the AI model will itself say that there is something which is going on.
True, sir. One last question for you. How do you foresee the future of GST data in India's financial ecosystem? And will it evolve into a standardized due diligence tool for capital markets in future?
100%. Already available. Already available when you can do a lot of due diligence through all this data which is available. The only point, as I mentioned you and you asked me, that the integration of the other data into the GST data will actually create a pathway for more prudence. So in my opinion, you have already the GST data available with you. You have to develop a lot of ratio analysis, a lot of analysis around that data, and then on the top of the things, that is the icing on the cake, you have to have the another data available which will validate your findings. For example, just to share with you one example, that your turnover is 500 crore.
Right.
But in the bank statement analyzer is showing you that your turnover is only 200 crore. So 500 crore is only on the papers. The actual turnover in the banks is only 200 crore. Debtors are only 50 crore. Meaning that 250 crore is only transaction on the invoices. Actual bank, there is no bank transactions available. So that will substantiate your findings that there is something circular trading or something is happening. So I believe that these things are already available. Once the more and more data will be available, it will become more, it will solidify the situation.
Right, sir. Thank you very much for sharing your insights on how GST tools and overall economic other tools, AI technology, how they can be useful in predicting investment scenario, how behavioral pattern in payment of tax, how the compliance patterns, everything these things will help in strengthening and predicting, analyzing good companies, good investment targets for various analytics, and the role of chartered accountants in understanding, because whatever you have said, these all things can be analyzed by a chartered accountant only, because as I said that we are the masters of figures, and therefore we can predict the future. And GST as a whole, which has been the largest and I think the most important financial reform since 1949, will play a great role into this. Now, coming to income tax, we had Mr. G.P. Ramaswamy sir, who is our past president, but unfortunately he's occupied into some important meeting with the government. So I shall be discussing some issues, some questions on this for the audience. Income tax, as it is my forte, my core subject. So how income tax shall be useful, I shall be discussing on those aspects. Durgesh bhai, would you like?
I think Atul sir will continue to join our
No, sir.
hopefully
I have another meeting at 5 o'clock.
meeting. I remember that when we have discussed about this. So you have a meeting, so you will be. Sir, no problem at all, sir. Thank you very much for being with us today and talking on the subject. where how the GST crystal ball can be used, and the in GST crystal ball, how the data how the GST can be used for the better investment. And when there were so many questions from moderator side, you have replied well, covering e-invoice, GST. The entire details of transactions are given to department. Also, the concept-based data helps in data mining, where you can use the AI, uh, which ultimately helps in a better data analysis and better decision making. This also helps in the transaction analysis. You have covered well. You also talked about HSN based classification, segment reporting, rate rationalization, ineligible credit, tax payment behavior of the companies which are there using up to 98% of the ITC. Ultimately, these kind of analysis helps the investors to look into the various things about the company, and this also helps in deciding what kind of corporate governance is there. Simultaneously, you also talked about the inventory buildup and other things, and what kind of AI modules be used for inventory buildup and other related matters. I think if a chartered accountant would really like to help the investor or to the companies for these kind of data analytics, for using the best investment decision, I think this is going to be a great opportunity. And I'm sure that all the participants who are there, who will get benefit at large by the discussions held and deliberations done by our past president, Sri Atul Gupta ji. And let me also tell all the participants that this particular episode of webinar will be hosted on the YouTube channel of the ICAI. So not only today, but in future also, anybody can use this webinar as a reference, and I'm sure it will help everybody. Sir, thank you very much for being with us on this day and guiding to the chartered accountants fraternity that how GST data can be used for the best investment decision making, and how a chartered accountant can make career in data analytics of GST and can gauge the crystal ball of GST. Thank you very much, sir. Once again.
Thank you very much, Durgesh ji. Thank you very much, Pankaj bhai and Jaya ji. Everybody, thank you very much.
Thank you, Durgesh bhai. How would you like me to proceed now on with regard to?
So now I would request Pankaj bhai that by the time Ramaswamy sir joins, I think you have approximately 20-25 minutes. And I know that these 20-25 minutes can be very effectively used by a person like Pankaj Shah, who knows that how the structuring of investment or share investment structuring can help in taking the tax decisions, and it is not tax avoidance. What better planning can be done through the structured investment via equity? I think you are the person who can guide the investors, or rather, I would say that a person who wants to start the business, who want to merge the entities, how the structuring via equity can be done, that will ultimately help. And I know I have heard you on this subject very carefully. So a person who is listening today and the members who have joined today, I think they will also get benefit of this. When we got a time of around 20-25 minutes, I think all will be beneficiary. So with this, Pankaj Bhai, you can take up this subject and go ahead with this, proceed with this.
Thank you very much, Durgesh bhai. Indeed, investment, capital markets, and Indian capital market, which are so buoyant right now, we are world leaders and we are self-reliant also. But in the Indian markets, we see many startups are coming. We have seen Zomato, Byju's, different types of startups are coming. Some are making very good, some are not getting so successful. So, how taxation also impacts these startups, how tax policies impact them, we'll be going to have a cursor, a discussion on all these aspects. First of all, we need to understand the financial market and financial instruments and what is the regime. Take, for example, whenever there is a merger, there are two big companies in a stock market, and we see that there is a prospective merger. What is the role of a learned person or a chartered accountant is to see the terms of merger, the scheme, all these documents are being provided to us, but we don't bother to have a look whether it is prejudicial to either of the company or how it is to be seen. I'll take a simple example. When we make amalgamation, one company is getting merged into another company, the consideration can only be in the form of shares. Now, by shares, one is having a misapprehension that it is only equity shares. Whereas, if I want to do a structuring where there is a merger or say a demerger, there are two parties. One party wants to exit the company, other party wants to take over and continue with the company. There are two promoters. Now, one party wants to go away. How the scheme is there? Because together they are not working together, one wants to exit, so consideration for demerger has to be in the form of shares. But yes, it can be in the form of preference shares. See, income tax includes shares and shares include both equity and preference shares. So when to be a tax compliant merger or demerger, amalgamation, demerger, what can be done? That instead of equity shares, preference shares may be issued. By issuance of those preference shares, which are redeemable in say 2 years, 3 years, or 5 years down the line, what will actually happen? It will be like a debt which has been repaid. So that is a very interesting form of merger where a clear-cut demerger is achieved, a tax-neutral demerger is achieved with the help of this kind of structuring. Another example is the use of DVRs. What are DVRs? Differential voting rights. See what happens. I can issue only two types of shares. One is equity, one is preference. But this is only for public companies. If there is a private company, I can issue a hybrid shares also. A share with some special right. If there is a big bungalow in a company and I want that my promoter should stay in that house, the right to stay in that house can be given to a promoter by virtue of a specific class of share which will be given to that person. So we have a equity share, we can have a preference share, and we can have a hybrid share or a share with a differential right, special right attached to that share, that whosoever is owning this share will have the right to stay in this property. This kind of shares can be issued in a private limited company. For public limited companies, you can have differential voting rights. I'll give you an example. I am a founder of a startup. Durgesh Bhai is an investor. Now Durgesh Bhai is investing money and he wants return on it. I want funds and my startup will become successful. But I don't want that any interference should be done in the control or decision making which is being done by me. How will I ensure it? So that can be done in a manner whereas I'll issue class A shares to Durgesh Bhai, which will have higher returns, and I can issue class B share which have higher voting rights. This was used in Zomato, Byju's, and all those startup companies where the promoters were given controlling right. if I am having one equity share, I'll have voting rights equivalent to 10 equity shares. And the investor who is holding one equity share, he will have dividend rights up to 10 equity shares, whereas control only one equity share. So this is another form of structuring or a restructuring where differential voting rights are being done. Now, these kind of differential voting rights, when they are used, these kind of differential rights are continuing in some listed companies. We need to analyze them. We need to study those. What are these companies? Then there are various other instruments like warrants, preference shares, CCPS, compulsorily convertible preference share, optionally convertible preference share. So whenever we are analyzing, many times these kind of shares instruments and differential equity and preference and debt instruments are issued by promoters for tax benefit purposes. So we need to have understanding of these tax purposes, so that whenever we are making an investment in the company, we should be aware about these kind of structures, so that while investing we know that we are not going to be prejudiced later if we are investing in a category of investment. In income tax, there are different asset classes and different rates of taxes. One benefit which has been done in last year, see, income tax is now on the verge of simplification. They want to simplify things. Therefore, there were earlier various debentures, bonds, which had 3 years holding period to become a long term. Now they have reduced it to 2 years. So almost all the capital assets will become long term in 2 years. Rates of tax have been modified. 12.5% is the long-term capital gain tax. No indexation was provided in financial instruments. For short term also, they have considered and reduced the rates of tax. Now, when we are making investments, one very important aspect are the events which are very closely related to income tax, like, for example, buyback and dividend policy. What is the dividend which is being given by the company? And this dividend tax policy, how does this impact? I'll tell you. Earlier, there was a dividend distribution tax, so that every tax was paid by company, and whatever the shareholder used to get was the net amount, net exempt income on which no tax was there. But because of this tax policy, there was a disadvantage to non-resident investors. Why? With every country almost, we have a double tax avoidance agreement. So that if a non-resident is getting some dividend income on which tax is already charged in India, it will be required to pay tax of that resident country again in his own country of residence. What was the elimination was that whatever tax I am paying in India, I'll get credit of that tax. But now, in case of dividend distribution tax, that kind of credit was not available. So to protect and to have a level playing field between domestic and international non-resident investors, they changed the policy that now dividend is taxable in the hands of shareholder. Company is not paying any tax. So now when a non-resident foreign investor is directly paying income tax and not the dividend distribution tax, which is not considered as a tax in the foreign country as their tax, what will happen is that they'll get credit of whatever tax on the dividend is being paid by those non-residents. This was an interesting move which actually increased international participation also and provided a level playing field to international investment investors also. Another aspect is various double tax avoidance agreements and the benefits given to them. For example, if somebody is making investment from Singapore, or say Mauritius, there are some tax benefit treaties that the tax will be charged only in the country of residence, and there is no tax in those tax havens. So whenever we are analyzing, we need to see which FIIs or FPIs have made investments and what are the rates of taxes on those countries and how the investments are being routed. Then buybacks. See, buyback was a very interesting aspect which used to be there. But now buyback is also getting impacted because of these taxation issues. For buyback, now it is considered as a deemed dividend. And I'll have to pay tax on whatever amount I'm receiving today, not getting a cost deduction therefrom. Income tax, you have seen every time when the budget comes, the stock market goes up and down. It is very sensitive to budget because these are very important. Taxation is a very important policy. So with every amendment and every policy, we have to analyze its impact. As far as devices, Atul sir has already discussed in a detail that how these different data metrics affects. I'll give an example, TDS. Now we have TDS. If you simply run through the financials and director's report and annual report of a company, you'll get to know what are the contingent liabilities, any big tax notices are there. For example, Vodafone, we have seen it was a very big investment in India, but it ran into litigation. When it ran into litigation, what are the litigation, what is the stage for analyzing that, and what is the probable liability? We have to go through the financials where we'll come to know about all the disputes of the company which are pending. So these disputes, tax liabilities, tax plannings, and how the exchequer is seeing into it will also have a very big impact on those things. Then rates of taxes. Earlier we had exemption for long-term capital gain. Then came 10% tax with 1 lakh rupees exemption. Then 1.25 lakh and rate has been increased to 12.5%. Tell me what will happen. See, we are also on the advent of a new law, Income Tax Act 2.0, which is 2025. It is making various efforts to simplify things. But let me take an example. Where to invest and from where to invest is also important. Take for example, I am making an investment in a company, I am paying 12.5% as a tax. But if I am a partnership firm and after this new income tax act comes into force, the provisions are so that a partnership firm will have to be compared what is the normal tax and what is the alternate minimum tax. Alternate minimum tax has been implicated, made applicable to every partnership firm in the new income tax law. In the old regime, it was applicable only when used to claim 35 AD or section 10 or some chapter 6 deductions of part C. But now it has been made applicable without any condition. So if I'm directly making investment, there will be different rate of tax. But if I'm making through a partnership firm, 12.5% is the normal rate, which is to remain. But 18.5% is another very important rate, which is AMT, alternate minimum tax. So for same instrument, for same investment made by individual, there is a different rate of tax. And from partnership firm, there is a deterrent rate of tax, higher rate of tax of 18.5% as a minimum alternative tax. So different tax policies are making differences, very big differences, I would say. We all know now every investment is now being reflected in AIS, TIS regime. We all are actually passing through return filing seasons. We have seen this 31st July, which was extended to 15 September. And almost every investment, single rupee share purchase and sale, we are getting details in our AIS, TIS mechanism. So these investments are actually being tracked. Income tax is having so robust information scenario. We are also getting information from the brokers. The brokers have to file annual information return, so they are also providing details. There is a crypto regime where there is very high adversarial regime of taxation because the government does not want to increase or impact on basically these kind of crypto transaction. So these transactions are also being there. Now, some questions which are very important is that what are the objectives of income tax 2.0? See, it is new income tax act, we know, but what has been done is 75% is just renumbering. They have tried to simplify the language of this income tax law. And see, simplification and certainty, these are two things which are actually impacting international sentiments and whatever investments are to be made. Capital gain regime is actually being rationalized. Now we have a simpler regime without any indexation issues. So yes, that is also going to impact. And the more stabler regime is there, certain regime is there, that is appreciable to the global markets also. For foreign portfolio investors and foreign institutional investors, and especially AIFs, alternate investment funds. We have now pass-through status, pass-through vehicle, and special provisions, which provide a certainty, clarity to these foreign portfolio investors, so that they can participate in Indian market with a clarity that this is my tax which I am going to bear. If they are sure, then they'll add it to their cost. So this cost is tax is basically a cost to civilization. Similarly, cost to investment also. TDS, TCS rates also, we have seen there is a reduction of those rates. There is simplification of rates, and foreign tax credit. We have already discussed about dividend tax. Foreign tax credit principles are also being relaxed. So this is very important. And as we all know, now new law is coming, and it is the chartered accountants who have always taken a lead in unlearning, learning, and relearning things. So chartered accountants definitely, ICI has already played a very crucial role. You must be aware that new income tax bill has converted now into a new income tax act, and almost 95 suggestions made by ICI Direct Tax Committee have been accepted, which is a very, very big step and big recognition by the select committee. These changes, these suggestions have been accepted by the government. So this is very important. Ultimately, income tax is moving towards simplification regime now. They are simplifying, they are making it more predictable and certain. There are various provisions for ease of doing business. Like the simplest thing is now ATC, ATG, all these deductions are gone away, and 12 lakh rupees is the amount, which is a whopping amount nobody had expected. That so high will be the basic exemption limit rebate which we are getting. So now income tax is becoming generous and more clearer in ensuring that there is clear and more surplus funds are there. See, for example, this income tax 12 lakh rupees exemption, this is, and to discourage ATC and other investments, how it is impacting. ATC, ATD, some investments were made for tax benefit in LIC, but now since those tax investments is gone, person is concentrating where he's getting good returns, and definitely equity markets have given good returns. So now equity, mutual funds, and other considered are there because now they are on a level playing field. There is no tax benefit on one investment and tax disadvantage on another investment. So now this policy of making it deduction less new regime is also making a big difference. 12 lakh is giving more surplus to the taxpayer for investment. So increase in limit from 7 lakh to 10 lakh was a master stroke, was a game changer, and which will definitely have wonderful impacts. Digital assets, now company law is also making every share to be dematerialized. So demat securities, these financial instruments, we are coming out with clear laws, clear FAQs on this. This is also very important. And as ICAI and chartered accountants, they are having a very big role in consultation and research. We are having our own research. Recently, I would like to update you that our institute was assigned by SEBI to research about early signals in any corporate fraud or insider trading or other things. So there may be a fraud which is ensuing, but if we come to know about it before it happens, that can definitely save huge money of investors. And on this aspect also, ICI is carrying out a research which will help the government, investors, and it will be a win-win situation for everybody how it can be done. Looking forward, India's goal of becoming global capital market hub, definitely with our market and such a large investment base, this is really going to make a difference. And with these things, these kind of liberalization and systematize, now every transaction can be checked. So fraudsters and other those transactions have reduced. SEBI is very active. NSE, BSE, CDSL depositories. We have seen the level of increase in depositories. FNO transaction, every transaction can now be verified. Uh, in income tax, now the law has stabilized for FNO transactions. All these derivative transactions can be easily seen now. Earlier, they used to be speculative. Now they have been considered as a business transaction, normal business transaction. So income tax is so closely connected with investments that every change and tweak in policy has some or the other impact. So this was basically about how income tax is basically impacting strengthening of capital markets and different kind of instruments, different rates for bonds, debentures. We have 20% rates. There is a consistency in tax policy as far as capital markets and investments are concerned for long-term capital gains or short-term investments. Even now, if I'm holding a listed or unlisted shares, the details, especially for unlisted share, details have to be given in income tax returns. So as it was said by Atul, by data is the new oil. So much data is available through our income tax and tax returns, so that income tax implications on this capital market and this income tax return ITR, AIS, TIS can be very useful tool to understand things at a large. So yes, definitely India's taxation regime is moving towards simplification and with data buoyancy, which will definitely help us in predicting various capital market scenarios in future about investments. Simple example is take a balance sheet annual report and what are the disputes taxation going on. One example, if there is a search or seizure in a company, income tax search and seizure, and there is some surrender, that gives certain idea about the impact on the integrity of the promoters if there is a surrender made through the company. So all these information now you get through the annual reports and financials, and this information is really very useful in predicting and understanding the financial market, capital markets, and strengthening the overall Indian capital markets. So I have shared some of my thoughts on this topic. Durgesh bhai, if convenient, we would like to listen from you also. If you have any ideas or any suggestions or overall outlook from your perspective.
Thank you for the address, sir. I think whatever you've told us about the indirect tax, I think the information was very much relevant. And also, me
No,
not
Zara,
being a part of chartered
Zara,
accountant
मेरा
fraternity,
कैमरा उधर.
I could understand a lot of things. So thank you so much.
वहीं
And
से कर देना.
now Kabra sir would take it
Yeah.
from here.
If
Durgesh bhai?
if any questions are there in the chat box, those questions, if you feel
Yes, we
which
can
is
consider those.
related to Pankaj Bhai.
We don't have any questions yet, sir. If any of the participants have any questions, I would request you to kindly put them in the chat box or the Q&A box. So we'd be happy to take them up.
If any question is there from the members, they can put in the chat box, which can be taken up by Pankaj as far as the investment restructuring through equity is there. And even otherwise, if some other question is also there, then definitely those can also, we'll try to reply to those questions also. Because I think another 5 to 7 minutes will take where Ramaswamy sir will join. Ramaswamy
Even
sir will
Durgesh
join.
bhai, in the meantime, I would like to supplement you that in the international tech scenario, now some companies are having global presence. There are MNCs, multinational companies, and every company is now subjected to transfer pricing for their transactions. And these transfer pricing transactions reports, any adjustments or litigation appears in the financials. So if there are huge transfer pricing adjustments made, that also indicates about the company, whether it is earning and acting in the interest of shareholders or taking money outside to their parent companies. So these transfer pricing provisions, safe harbor rules, all these information also is evident from the annual reports of those companies, as also the litigation market reports, because transfer pricing addition, they are having huge impact, and almost all the listed companies are subjected to transfer pricing implications, transfer pricing provisions. So those kind of provisions and impact is also important to be considered before making investment in any company or any regime. Specifically, then some other aspects, some companies also go for capital reduction and other techniques also capital reduction, changes in the class of shares, conversion of their securities. So these are very important aspects which we need to see. Some company may convert their equity share into a debt or preference share. Nowadays, it is very aggressive. If we see, we have seen some consultants that you cannot issue irredeemable shares, but when you read beyond the lines, definitely we will not recommend it. But people, what do they do? You cannot issue irredeemable shares, but you can issue redeemable share and then convert it into irredeemable. There is no bar for it. So these kind of different strategies are there. If we see these kind of conversions, that also gives a look into future litigation and aggressive profile about the company, what kind of profile it is having. Then loans, unsecured loans, advances, what is the risk profile, debt profile, that is also very important. Interest cost, interest taxation, these also give interesting ideas about an investment target. As far as then the income tax plays a crucial role in deciding and discussing these kind of things. There is a question from Bhakti Shah. Is DVR a good option for listed companies? Would that have an impact on overall capital market of the company? See, whenever DVRs are there, differential voting rights have been given to somebody. It is given to favor that person. Some higher rights are given. Now we need to see what is the commercial rationale. If it is for maintaining control over the company, it is advisable. But if it is for returns and you are giving prejudiced returns, then that may not be appreciable, and we need to decide. So DVR is a solution, and how much DVR to be given is depending on the problem situation, where we need to take a call on case to case basis. Nowadays, NCLT things are going on. We have seen under NCLT debts are being restructured and being waived. There is tax implication. For example, you must be aware that if there is a term loan or those kind of loans and those get waived, there is no taxation and it was considered as a capital receipt. But now there is an amendment that if there is a loan waiver, that is being considered as a income. Any loan waiver of the working capital loan after Mahindra is overruled by the new amendment, it is now considered as an income under 28(4). So these kind of moves are also there. For mergers, amalgamations, I would suggest we should definitely go through the scheme of merger. What is the scheme? What is the consideration clause? What is the exchange ratio? And we would like to welcome Honorable G. Ramaswamy sir, our past president and doyen of the profession. I would request
Good evening, sir.
Durgesh bhai
Good
to
evening.
welcome Ramaswamy sir.
Good evening. Good evening.
Good evening, sir.
I'm very sorry I
Thank you.
joined late because of some meeting I have held up. The Vice President of India, His Excellency Mr. C.P. Radhakrishnan was here. So we have come here to meet, but because of the heavy rush, we are not able to come out. I hope.
No problem. No problem, sir. Thank you very much for joining. Meanwhile, the time was utilized by the moderator, Pankaj Shah, who has guided how the restructuring or structuring can be done by using equity as a tool, and how the best taxation part can be utilized. So he has guided on that subject. Meanwhile, sir, I welcome you once again, and I wish that the first part was related to the GST, crystal ball gazing, data analytics, how will help the better investment decision and due diligence before the investment decision. This was with respect to GST, where Atul Gupta ji was there. Now, now you are there, sir. The new Income Tax Act has come. How this new Income Tax Act is going to help the Indian capital market, which is going to grow from where the economy of the India is going to grow from $4.2 trillion to $35 trillion by 2047, which is the dream of our Indian leadership. And I'm sure that chartered accountant being the partner in nation building and a real partner in the capital market and financial market too, a proper tax guidance and transparency and the provisions which are related to the capital market are
Correct.
being deliberated and discussed, I think will surely boost the Indian economy, and we will be 100% be adding to the economy of this country.
Correct.
Our contribution will be there. So with this, sir, I will not take much of your time and the time of all the participants here. And I would request straight away to Pankaj Shah to deal with the subject and start your session.
Okay.
So I'll request Pankaj to go ahead.
Thank you, Durgesh Bhai. We have the presence of Honorable G.P. Ramaswamy, sir. Sir, how do you see? We would like to listen from you on your views about this new income tax regime, how it is going to promote and how it is going to strengthen the Indian capital markets. That is the open topic on which we would like to listen from your visionary words and your outlook in the future. Is what we expect from you, sir.
Sir,
Over to G.
thank you. We have seen our Indian Income Tax Act since 1961, more or less. I can't go beyond that. 1961, it has a lot of impact on our regular investment pattern. Maybe there are more, somebody has mentioned about this income tax 1961 has dissected maybe many times. They are not focusing on more on corporate restructuring, more on the corporate equity participation, more on capital market. Nothing has happened for a long time. Maybe on a more on the in progressive, I can say the lot of restrictions, provisions, explanations, so many things have happened in the 1961 Act. But fortunately, people have started to understand what is the very important for these countries' perspectives. See, there is a foreign direct investment, foreign institutional investors, so many mergers and everything's taken place. But the new income tax 2025, the income tax, you can say that's income tax 2, has come out with a clear strategy for the capital markets. Complete removal of all this tax structure, that is one thing which has been stabilized now. And there is a complete focus for a investment by the small investors to the retail investors to the big investors. Investment started very lucid way without any difficulty. You can see that every mutual fund companies, every investment companies, every investment advisors, they are coming out with a clear strategy and explaining that what is the law today. An individual, a common investor, retail investors, they're able to understand the simplified language of the new Income Tax Act 2025. The applications are very clear, regulatory mechanisms are clear, digital investments, digital brokers are there. They are able to do that. The startups are number of startups. Zerodha, it's one of the startup we can say. And interestingly, any individuals, even a small investor, they can use the digital platform. They can use all the investment patterns. So as on today, the income tax law, the Income Tax Act 2025 is giving a more on a proactive, positive, supportive nature for the capital markets, especially for retail investors. Anybody can understand the law, today's investment pattern. The large number of investment consultants are there. Large number of platforms are open for the investors. That shows that day one, if they start, every second they will see the movement of the act, movement of the market. And this is an easy way. The laws are not complicated and the rates are completely streamlined. All these things are very important through this the Income Tax Act 2025. I feel this is a full comfort for the capital market. You can see that also. Wow, it is growing very fast. Especially retail investors, we have to appreciate. Foreign institutional investors are able to understand the law and they are also coming forward for an investment. It's a good for the capital market because of lucid, simple language, understandable, unambiguous, and completely and open to understand. That's my view.
Great, sir. Thank you so much. What implications the revised income tax provisions on foreign portfolio investors' participation? Are there any specific provisions for those FPIs?
FPIs, I can say that there is not much of the difficulty for them compared to all the other previous regime. I feel it's comfortable only.
Right, sir. How does the changes in TDS and TCS regime impact capital market transactions, especially in context of digital platform and fintech brokers?
Of course, there is a TDS, TCS provisions. Now, as on today, this fintech and the capital markets, see, for it's a digital platform, you take that automatically it is taken care of. Not of complexities are not coming, simplified. Nothing is affecting of the ordinary way of other provisions. The fintech and also as the capital market people are enjoying that. There is no problem at all.
Great, sir. How can now chartered accountants play a role and contribute to the transition from old to new tax framework for capital markets? Because this is going to bring changes and so what would you envisage our role of a chartered accountant here?
See, first of all, you compare the chartered accountants roles compared to about 5 years back and today. Completely changed, reformed. See, about 10 years back or 5 years back, the chartered accountants more focused on the audits related issues. Maybe focused on certain related areas like your compliances, related areas for smaller advisory role. Today, the chartered accountants are playing a very important role to understand how these capital markets are moving nationally or internationally. I can say that because this is of the opened up for the chartered accountants. They themselves now they are also investing. You see that chartered accounts many times they are not bothered about their own investment portfolios. They are not bothered about their own the maintaining of their personal agenda of keeping the wealth in future wealth. We are giving more advices to everybody. That's their understanding about the tax laws, and immediately they were able to do that.
Great, sir. We all have been hearing about this ease of doing business.
Yes.
What do you feel the government should do? What tax reforms for ease of doing business should be brought for startups and SMEs aiming for IPOs or for further growth through any other modality?
Very good. That's a very important point. Now, India is the third largest startups in India. Huge amount of MSMEs are contributing towards the capital market development and everything. Now, SME, the IPOs are coming from the SMEs, and the startups are growing big. There are a lot of the streamlined method of registration with the Department of Industries by the startups, and the level of the MSMEs, what the capital has been increased. Now that there will be 43 BH is giving some comfort for the MSMEs to grow fast, collect money, and don't depend upon only bankers. So there is a complete streamline happen in the minds of the MSMEs for a comfort level of financial angles are coming up. As on today, the SMEs, the IPO is in one area where SMEs are able to jump into the areas and they can tap the capital market. And relating to startup, the number of changes happened in the startup relating, for example, the one area where there is a deemed income. They have given a benefit for deemed income is not applicable for startups if they are going for a big, because of somebody is investing. The valuation of shares, the difference between the valuation of shares and actual amount. See, for example, the premium they have gained out of the investment, it is not covered under the deemed income. There is a capital market other side also. They are all, many of them are interested, angel funds are all interested to use the money for the development of startups. So naturally the startups, MSMEs are now is getting a lot of tax benefits as well as tapping the market. Only things which are required for an MSME is the good corporate governance should be inculcated by the chartered accountants with the MSMEs. MSMEs are getting benefit from the government. MSMEs are getting the registration because of their capital, the asset value increase, investment value increase. The concept of definition of the MSMEs are also changed now. So naturally, we need to have a good corporate governance, compliance requirements, and of course, there are number of faceless assessment. Now it is there. There is no question. Then immediately they are filing of returns. There is no question. And there is a lot of compliances to the digital platform. It will be very useful for startups and MSMEs can specifically business activities.
Great, sir. Now, one very important thing we have all seen that litigation is something which has ever been increasing in income tax. What steps are being considered to reduce tax litigation, especially in capital market cases under the Income Tax Act?
No, capital market litigation, you are all aware of that, especially the penny stock cases. You must have read. I'm always love to read your decisions you are sharing with people, shared with joint developments, agreement, and all these things, the applications, how these agreements to be read, and how joint development concept, everything you shared with the government. You're sharing that. And especially penny stock cases. May I have seen that penny stock cases everywhere, tribunal level, something is happened. So what we needed is a simplified tax compliance for the capital market is required. There are number of intermediaries, number of retail investors, number of investment advisors. I don't know how that has to be completely streamlined is very important point today. Ease of doing business, government already started they want a decriminalization of the Companies Act. Last 2 years back, we completely decriminalized the Companies Act. Because of that, there is no need to go for a criminal notices, except certain cases, to a director and all of them. Second, now the compliance also on a digital format. So that one more, the easy form of registration litigations are coming up in many areas, especially with reference to the capital market. The valuation is a very important point. Valuation is, for example, a private limited companies, a public limited companies, unlisted companies. If they want to go for a share issue, if they want to go for the issue of shares to the outsiders, and a lot of litigations about the valuations. Either it may be a DCF valuations or it may be 11 UA valuation. There is a streamlined valuation is required for the purpose of transfer of shares, acquisition, mergers and demergers, especially for an IPO and all these things. That we have to understand that. So there should be a restructuring of a valuation methodology is required either through the bankers or through a chartered accountants. Back with all the valuation qualified person should be there. Now we have a registered valuers. Chartered accountants are becoming registered valuers. So their need use of the registered valuer is very important in the case of a valuation. Because of that valuation only is the lot of litigations are coming up. Tell me, sir.
Right, sir. Great. Any concluding remarks on how tax framework can support goal of India in becoming a global capital market hub and the role of chartered accountants? Your concluding remarks on this, sir.
As a council member, present council member, all youngsters are occupying in the council. You're all giving a lot of inputs today. First, one towards the opportunities for chartered accountants. I must compliment the Mr. Durgesh Gabra for one day we discussed about the introduction of the certificate course for the chartered accountants as an investment bankers. Investment banker is a buzzword. Anybody can say investment banker, but we are not able to say investment bankers because of certain reasons. So we had to do some work for our profession for gearing up towards the investment bankers role that we have started. I'm really compliment all of you for this. Second, the concept of angel funds, concept of the joint venture, concept of demergers, so many things are coming up. We need to play very strongly on these aspects. So today, globally, the markets are open. India is not free from this global market. We have a global chartered accountants we want, global business we want. So naturally, there will be a more and more transparency required. Today, the concept of virtual assets are also very important. Virtual assets are coming, defined. Cryptocurrencies are coming in that from process of investment, and there are certain regulations. But we should see that there should be, like in Gujarat, we have a free trade center we have opened. So like that, we have to open different places. Not only Gujarat, it should be spread over all the places, including Indore, Coimbatore, all the places where you and me are coming. So there should be a global market will be open. Industrial cluster in India will get the benefit out of it. The investment opportunity will create more wealth for the India. That should be more and more the free trade centers should be opened. See, in case if you want to do the IFSC that we have, you are going that gift city, it should be treated as the foreign country there. Like that, some more areas should be opened as like a gift city, then capital market will grow. It's very important. Our Indian players can open and globally.
Thank you very much, sir, for your enlightening words. It was really, really enriching for all the participants today who have joined today. Durgesh Bhai's idea and your discussion of certification course for investment banker for chartered accountant is something which will be really a game changer for all the
Exactly.
future of the profession, sir. That is very insightful, sir. It is said that when enlightened minds meet, they create something positive and something constructive. So thank you so much for joining. Durgesh Bhai, any concluding remarks if you'd like to
Thank you
speak?
for what all, because I was there in a big meeting. That's the one meeting which I have not able to come out.
Right.
The Vice President of India was there in Coimbatore. We all attended the program. First time he's from a Coimbatore person. So we have to with them. That's why I was not able to reach immediately. But however, you have taken a lot of pain. You have explained everything. But one concept, my appreciation to Mr. Durkesh Kabra for introducing, and the President of the ICA, Mr. Dynamic President, my good friend, Mr. C.A. Nandaji, for this wonderful initiative of investment banker certificate course. Thank you, one and all.
Thank you, sir. Thank you, Durgesh Bhai. Durgesh Bhai, mute. You're mute. Still mute.
He cannot be a mute spectator.
Yes, sir. Appears some technical problem from. In the meanwhile, I'll propose my vote of thanks to Honorable Atul Gupta sir and G. Ramaswamy sir for the session. Yes, sir, Durgesh Bhai.
Hello?
Yes,
Can you listen
Durgesh
me?
Bhai.
Yeah, thank you. Sir, it is indeed a pleasure that in spite of so much busy schedule and having presence with the Vice President of India, C.P. Radhakrishnan you could make it and could guide the members present in the webinar. I'm really very much thankful to you. You have also covered well the areas which is going to make difference for the investment in the capital market, more specifically with respect to the various new provisions in the new Act, Income Tax Act, where there have been a lot of provisions which is going to help the MSMEs and these provisions will streamline the process for raising the capital via IPO for SME platform, and this SME platform capital market will get another strength. The reason being, when I was talking to the NSE chief of the SME IPO, I have been told by him that there are around 20,000 SMEs which they have shortlisted. For them, the listing on the exchange is a cakewalk if they wish to. And today, in 1,200 companies, the market cap is of around 2 lakh crore. When 20,000 comes to the market, which are the SME, you can think of what kind of market cap will be there from the SME side. So I think you covered about the SME startups, lot of tax benefit which they are getting. It will definitely boost their capacity to raise the capital from the market and will help the SME and startup to grow. You have also dealt with the compliance with respect to the capital market, and as far as the valuation is concerned, which is also very, very important, and you have touched upon this also, where the registered valuers can be used and the proper transparency can be brought into the valuation of the company, valuation of the equity shares, which ultimately helps in more transparency and more strength in the capital market, and the best strategic decision with respect to the investment can be done. Sir, I'm really very much thankful to you on behalf of the whole of the committee, as well as my vice chairman of the committee, Dayanivas Sharmaji, and wish that you continue to guide us. It was your motivation, encouragement with respect to the certificate course on investment banking. When I came and met you at Coimbatore, you just suggested, and I have taken it up, and this was an inspiration from you, so we could start at the ICAI. And please always feel free and guide me, so we can take up such other avenues for building the capacity of young chartered accountants, where more opportunities can be created for the fellow professional brothers and sisters. For this, thank you very much, sir, and over to Pankaj.
Thank you.
Thank you, sir. Thank you so much to Honorable G. Ramaswamy sir, Atul Gupta sir, Durgesh bhai, Daya bhai, team of ICI who were behind this seminar, and all the participants for joining and learning this seminar. Thank you very much. Thank you, sir.
Thank you.
And
Thank
thanks
you
to thanks to Pankaj Shah also, sir. Beside being the moderator of 2 sessions of this webinar, he has filled the gap and has guided on the structuring through the equity. So that is a very good thing which has happened today. So thanks to Pankaj also, and thanks to Sangini and the office team for doing best with respect to this webinar. Thanks to all of you.
Thank you.
Thank you, sir. Thank you.
Thank you.
இல்லைன்னா அடுத்த இதுல போயிடலாம்.